Costco just sent a jolt through Wall Street with a surprising earnings report that has experts raising their eyebrows, and not in a good way. Beneath the surface of their numbers lies a warning that could signal trouble far beyond just one company. In fact, what Costco revealed might be a glimpse into the deeper cracks forming in the economy itself. According to Costco's chief financial officer, consumer behavior is shifting in ways we haven't seen in years. People aren't spending the same anymore. Inflation, which continues to gnaw away at everyone's wallets, is no longer just a headline. It's reshaping how people shop, no matter their income level. That alone should raise alarm bells. Now, let's not forget, Costco isn't just any store. With more than 850 locations globally, including nearly 600 in the US, it has long stood as a symbol of retail strength. Its business model is simple, yet powerful. Offer quality products in bulk at unbeatable prices, all while locking in loyalty through a wildly successful membership program. And when we say successful, we mean it. Costco holds an astonishing 93% membership renewal rate, a number most retailers could only dream of. For decades, Costco has weathered storms and stood tall during economic uncertainty. But now even this retail giant is flashing warning signs. What does it mean when a company known for stability starts showing signs of strain? The answer might be more unsettling than we think, and we're just getting started. Costco's latest earnings report has exposed some cracks in the foundation, even for a company that's long been seen as nearly bulletproof. While it may seem like business is booming at first glance, the details paint a very different picture. In their Q2 2025 report, Costco announced a 4.2% increase in total revenue compared to last year. Sounds solid, right? But don't let that number fool you, because the real story is buried deeper. Their same-store sales, which show how well existing locations are doing, only rose by 1.7%. That's less than half of the 3.5% growth analysts were expecting. And Wall Street didn't take that miss lightly. As soon as the report dropped, Costco's stock slid sharply, down 5.8% during the day, and even further, 8%, in after-hours trading. But here's where things get really interesting, and a bit unsettling. On the company's earnings call, Costco's CEO didn't sugarcoat the situation. He pointed out a noticeable shift in how people are spending. Shoppers are pulling back from non-essential items, becoming more cautious, and focusing almost entirely on necessities. And this is happening even at Costco, where low prices are practically the brand's identity. What's more alarming is the shrinking size of shopping carts, literally. Customers are buying fewer items, and the drop in discretionary spending is clear. Sales of electronics and big-ticket items plummeted by 6.8%, signaling that even middle and upper-income shoppers are thinking twice before spending. This isn't just about Costco. It's a bigger signal. If a retail powerhouse like this is struggling to maintain growth, it's a strong indicator that consumers across the board are tightening their belts. And this is just one piece of a much larger economic puzzle we'll be unpacking. But starting with Costco, that's our wake-up call. While food and everyday household items at Costco saw a 4.3% increase in sales, there's a much deeper story behind that number, one that speaks volumes about the current state of the average American household. Costco's CFO summed it up perfectly. Consumers are becoming more value-conscious than ever. But why is that happening now? Well, the answer isn't hard to guess. With the cost of living soaring, groceries, rent, energy bills, and just about everything else getting more expensive, people are being forced to rethink every dollar they spend. Saving money isn't a choice anymore, it's a survival tactic. A recent survey from the National Retail Federation revealed something striking. 72% of consumers now see warehouse club memberships not as a convenience, but as an economic lifeline. These memberships have become essential tools for families trying to stretch shrinking budgets in a world where every cent counts. Yet here's the twist. Even in this so-called value zone, people are pulling back. Around 58% of shoppers admit they're cutting back on non-essential purchases, compared to just 6 months ago. Let that sink in. Even inside Costco, a place that's practically designed for smart, budget-friendly shopping, people are choosing to walk away from anything that isn't a necessity. And it's not because Costco's pricing isn't competitive. Their basic Gold Star membership is only $60 a year, and the executive membership, at $120, actually pays off for frequent shoppers thanks to its 2% rewards program. It's one of the best deals in retail, yet people are still hesitating. When shoppers are tightening their belts at Costco of all places, the warning is clear. We're not just dealing with cautious consumers. We're watching a shift in the entire economic mindset. And that's a red flag no one can afford to ignore. Costco's CEO made something crystal clear during the latest earnings call. They're not following the crowd when it comes to flashy discounts and one-off promotions. While other retailers are scrambling to lure shoppers with limited time only, sales and clearance events, Costco is sticking to its tried and true strategy, everyday low pricing. And in this economic climate, that says a lot. Last year, they did introduce a one-time stock up and save event instead of jumping on the typical inflation buster trend. The event gave members an extra 20% off on select bulk items, but even that was a rare exception. For the most part, Costco believes in offering low prices all the time, no gimmicks, no countdown clocks. And let's not forget the iconic staples that have come to define Costco's commitment to value. The legendary $1.50 hot dog and soda combo, still the same price it's been for decades. The $4.99 rotisserie chicken, untouched by inflation. These aren't just food items. They're what Costco calls value anchors, meant to draw people in and remind them that this is still the place where your dollar stretches farther. I'll be honest, I've been a Costco member for years, and it's still one of the best retail deals out there. Their Kirkland signature line consistently punches above its weight, often beating national brands in quality at a fraction of the price. Consumer Reports backs that up time and time again. But here's the thing, and it's the part that should really make us pause. Even with all these unbeatable prices and trusted products, consumers are still pulling back. That's not just about shopping habits. That's about a shift in the economy, in confidence, in the way people feel about what lies ahead. And if Costco, arguably the king of value, can't escape it, then the storm may be bigger than we thought. The fact that even Costco shoppers, who are typically value-driven and loyal, are starting to cut back should raise serious red flags for anyone paying attention. And Costco isn't alone. Another familiar name in retail is once again in the headlines for all the wrong reasons. Bed Bath & Beyond. Yes, they're still around, barely. After filing for bankruptcy and getting scooped up by Overstock.com last year for just $21.5 million, a shocking drop from what the brand was once worth. They're still trying to hang on. But survival hasn't been easy. In a fresh blow, the company just announced it will be closing another 45 stores across the country. To put that in perspective, Bed Bath & Beyond once had over 1,500 stores, stretching from coast to coast. Today, fewer than 350 locations remain, and even those are mostly huddled in large cities. It's a slow and painful retreat from the national stage. Just recently, 3 stores in the Chicago area shut down without fanfare. No big farewell, no special closing sale, just a quiet sign in the window that read, "Thank you for your loyalty. This location is permanently closed." That's it. There was no official explanation, but let's be honest, it doesn't take a genius to figure out what's going on. It's the same story playing out across the retail landscape. Declining sales, fading foot traffic, and a consumer base that's more hesitant than ever to spend money on non-essentials. What's happening with Bed Bath & Beyond isn't just about one company's downfall. It's another chapter in a bigger story. A story where even well-known brands with decades of history are struggling to survive in an economy that's shifting under our feet. And if that doesn't send a chill down Wall Street's spine, it should. When even a powerhouse like Costco starts to stumble, it's no longer just a blip. It's a warning. Costco is one of the most successful retail giants in the world, boasting some of the highest revenue per square foot in the entire industry. They've been a benchmark for stability, efficiency, and value. But now, even they're showing visible signs of economic strain. And that's where things get serious. What's happening at Costco isn't isolated. It's part of a much broader shift in the economy. Changing consumer behavior, tightening wallets, and a rising need for companies to protect profits have triggered a domino effect. And we're only at the beginning. Across industries, major corporations are beginning to slash jobs in alarming numbers. Intel just announced a massive layoff, 15,000 employees, which is about 15% of its global workforce. Goldman Sachs, one of the most powerful names in finance, cut 3,200 positions. Even Hasbro, a company built on childhood joy and nostalgia, laid off 1,000 workers. This wave of layoffs isn't just a list of headlines, it's a growing storm. Each job lost means less spending, less consumer confidence, and more pressure on businesses trying to survive. It's a chain reaction that spreads far beyond the companies themselves. And while we're seeing this unfold on a national level, what's going on inside Costco's walls might be one of the clearest signs of just how deep this economic downturn is becoming. We're about to dive into those Costco details next. But keep this in mind, when giants begin to stumble, the ground under everyone starts to shake. During their latest investor call, Costco revealed something that sent a ripple of concern through the financial world. Foot traffic at their stores dropped by 2.3% compared to the same quarter last year. That may not sound dramatic at first, but here's why it's a big deal. This is the first time in nearly 4 years that Costco has seen a decline in foot traffic. And for a company known for its resilience, even in tough economic times, that's a flashing red light. But it doesn't stop there. Executive membership renewals, while still strong at 90%, have dipped by 2 percentage points year over year. That might seem minor, but when you understand Costco's business model, it's deeply concerning. The company doesn't make huge profits from selling products. Their margins are razor thin. Instead, the real money comes from memberships. In fact, about 75% of Costco's operating income comes from those annual membership fees. If renewals keep slipping, the foundation of Costco's profitability could be shaken. That's not just a problem for them. It's a signal to the rest of the market. Because here's the thing. Costco customers come from all walks of life, across every income level. What ties them together is one key trait. They're value conscious. So, when even these smart, budget-savvy shoppers begin pulling back, it's often the first sign of broader economic caution. Costco has always been considered a leading indicator of consumer sentiment, and right now, those indicators are blinking yellow. We're still early in this shift. Most of these changes have only been happening over the past quarter. But make no mistake, this is just the beginning. The ripple effect could soon be felt across retail, finance, and employment. And don't forget, this is all happening alongside a steady stream of layoffs and corporate downsizing from major companies across the board. It's as if every sector is holding its breath, bracing for impact. What we're seeing at Costco might just be the first crack in a much larger wave of economic turbulence still heading our way. Best Buy just dropped a bombshell this week. They're laying off 3,500 workers, all from their retail stores. And while these aren't high-paying corporate jobs, they represent something far more important: the beating heart of everyday consumer spending in America. Just like many Costco workers who are quietly seeing their hours cut as the company adjusts to shifting demand, these layoffs reveal something deeper. People simply aren't spending like they used to. This isn't a sudden change for Best Buy either. The company has been struggling with declining sales for several quarters now, and the cracks are starting to show. But what's especially telling is who they chose to let go. None of the cuts are hitting corporate offices, distribution centers, or the Geek Squad, just retail workers, the people on the front lines, the people interacting with customers every day, the people whose income fuels their own consumer spending. Now here's the part that really pulls back the curtain on how the system works. Right after Best Buy made the layoff announcement, their stock price went up by 3.2%. That's right. Wall Street cheered the layoffs. Why? Because fewer employees means lower payroll costs, which means higher profits. Investors love that. It's something we've talked about many times before. Just watch what happens after a layoff announcement. In most cases, stocks go up, not down. And it's not just Best Buy. Gap Inc. recently announced they're cutting 400 corporate jobs. Walgreens is planning to close 1,200 stores over the next 3 years. Everywhere you look, the signs are piling up. These aren't isolated decisions. They're part of a bigger, more troubling trend. Consumer confidence is crashing. According to the latest data, it just saw the biggest monthly decline since August 2021. That's 3 months in a row of sharp drops, and it's now at its lowest point in nearly 4 years. Why? Because people are scared. Scared of inflation, scared of losing their jobs, scared of what's coming next. We've spent the last year hearing how strong the economy supposedly is. But now, reality is catching up. The story is changing. And what we're seeing with these layoffs, store closures, and falling confidence, it's not just noise. It's the early warning signs of something much bigger brewing beneath the surface. And it's time we all start paying attention. Home builders are sounding the alarm, and it's louder than ever. The NAHB/Wells Fargo Housing Market Index, a key measure of homebuilder confidence, just dropped to 35 in April 2025. That's a steep fall from 51 just 6 months ago. To put that in perspective, any reading below 50 means more builders see conditions as poor rather than good. And now, confidence is slipping fast. Why the sudden downturn? Builders are watching every red flag pop up at once. They're expecting fewer home sales, more price reductions, and a growing number of potential buyers who simply can't qualify for a mortgage in this high interest rate environment. It's not just about what's happening now, it's about what they see coming in the next 3 to 6 months. And right now, what they see is bleak. What makes this so concerning is how fast the tone has shifted. Just a few months ago, economic optimism was everywhere. People were saying the worst was behind us. But that optimism, it's evaporating. And if you've been following this channel for a while, this won't come as a shock. We've been warning that the economy isn't on solid footing. It's been floating on shaky promises and temporary boosts. This isn't just about housing. It's about the deeper cracks forming in our financial system. Companies that don't make sustainable profits are finally being forced to face the music. Layoffs are happening, consumer confidence is crumbling, and now, even the housing market, which is usually one of the strongest signals of where the economy is headed, is showing signs of collapse. The U.S. economy desperately needs a reset. We need real growth, real stability, not just inflated numbers and endless debt. For too long, we've been drifting away from true prosperity, and now it's catching up to us. According to the latest report from the Conference Board, consumers have become increasingly pessimistic, not just about the current situation, but about what's coming. Confidence in future business conditions is slipping, and expectations for personal income are fading. And honestly, can you blame them? Look at everything we've discussed so far: rising layoffs, store closures, slowing consumer spending, cracks in the housing market, inflation that refuses to go away. The mood is shifting, and fast. People aren't just worried anymore. They're preparing for what feels inevitable. Even the Federal Reserve is starting to worry. Inflation is still hanging around like a storm that won't pass. And despite everything the Fed has done to fight it, the results just aren't there. Their goal has always been to bring inflation back down to that safe 2% target. But here we are in 2025, and not only has that target not been met, we're starting to see inflation creeping back up again, at a time when it was supposed to be cooling off. That failure is beginning to echo through the entire economy. People are changing the way they spend, save, and prepare for the future. Fear doesn't just live in headlines anymore. It's made its way into everyday life, and once that fear takes hold, it becomes a self-fulfilling cycle. Lower confidence leads to less spending, which leads to lower growth, which leads to even deeper concern. Some economists are trying to calm everyone down. They say, don't panic over one bad month of consumer sentiment. They argue we need to look at long-term trends, and they point to June 2022, when consumer sentiment hit a record low during peak inflation, but Americans still kept spending. But let's be real, June 2022 might as well have been a different world. Back then, people still had leftover stimulus cash. They hadn't yet burned through their savings, and credit was a lot easier to access. Fast forward to 2025, and it's a very different story. People have been squeezed for over 2 years now. The prices haven't come down. They've just stopped rising as fast. That's not relief. That's just slower pain. And here's what most of those optimistic reports never mention: what it actually feels like to live in this economy right now. The financial stress is real. Families are cutting back on everything from groceries to gas. Households are skipping vacations, delaying car repairs, even rationing essentials. That's the kind of silent suffering that doesn't show up in every statistic, but it shows up in the checkout line, in the job searches, and in the growing fear people feel every time they look at their bank account. The truth is, the numbers may take time to tell the full story. But for millions of Americans, the story has already begun, and it's not headed in the right direction. Of course, people are still spending, because life doesn't just pause. You still have to fill up the gas tank, buy groceries, pay rent. But here's the catch: if everything costs more, then it looks like spending is going up, even when people are actually buying less. That's the deception hidden in the numbers. You're not buying more. You're just paying more for the exact same things. And that's not growth. That's inflation quietly eating away at purchasing power. Now compare that to where we are today in 2025 versus a few years ago. Back in 2022, inflation was a big headline, but people still had some breathing room. There was leftover stimulus money floating around, savings cushions were bigger, and confidence hadn't completely collapsed. But today? It's a whole different story. Today's economy is built on a shaky foundation of fear and uncertainty. People are worried about their jobs, about rising prices, and about what's coming next. And when people feel uncertain, they pull back. A recent survey from Morgan Stanley just confirmed that 68% of Americans said they plan to cut back on discretionary spending. That means fewer dinners out, fewer online shopping splurges, fewer vacation bookings. Why? Because they're not sure if they'll still have a steady paycheck next month, or if their bills will climb even higher. And honestly, that's a smart move. On this channel, we've been saying it for a while. This is the time to be cautious. Save where you can. Prepare for volatility. The road ahead isn't smooth, and no one's coming to rescue the average consumer. Now, will this kind of cautious behavior actually speed up the downturn? Maybe. When people stop spending, the economy slows. That's basic economics. But what's the alternative? Pretend everything's fine and go broke, trying to keep up with a lifestyle that's no longer affordable? That's a recipe for disaster. People are waking up, and they're realizing that survival comes first, even if it means the economy takes a hit in the short term. And yes, start saving more. Not just because it's the responsible thing to do, but because it's essential right now. Making sure your bills are covered, your family is secure, and you've got something stashed away for the unexpected isn't a luxury anymore. It's survival. But here's the ironic twist. When millions of people pull back and tighten their wallets, the economy slows down even more. It creates a chain reaction. Less spending leads to lower business revenue, which leads to more layoffs, which leads to even less spending. That's the spiral we're in. And once it starts, it's hard to stop. Morgan Stanley pointed out something crucial in their latest report. They said the value of the dollar, the real value, in terms of what it can actually buy, is becoming less reliable. And that uncertainty is pushing people to rethink how they spend. Think about that. When you can't count on your dollar to hold its worth from month to month, you stop spending and start protecting. No surprise there. This is exactly why we've urged people, time and time again, to get out of debt. Every dollar you owe is a dollar you can't save. Interest payments eat away at your ability to build any kind of financial cushion. Being debt-free means you've got flexibility. It means you're not stuck throwing your hard-earned cash into a black hole while prices keep rising around you. And that's where smart investing comes in. We're not talking about risky bets here. We're talking about preserving real wealth. Assets like precious metals, real estate in select markets, and dividend-paying stocks aren't just buzzwords. They're tools that can help protect you when cash starts to lose its value. You're not just piling up paper, you're investing in things that hold tangible worth. Morgan Stanley's survey revealed another interesting trend. 77% of Gen X and a staggering 81% of baby boomers are now changing how they manage their money. Why? Because they've seen this story before. They've lived through inflation, recessions, housing crashes, and they know when the warning lights are flashing. And right now, they're not just flashing, they're blaring. Things. And that's okay. But doing something is better than doing nothing. If you're just starting now, here are the most important steps you can take today to weather what's coming. 1. Cut unnecessary expenses. Go through your budget with a fine-tooth comb. Cancel subscriptions you don't use. Delay big purchases that aren't urgent. Prioritize essentials: food, housing, utilities, transportation. 2. Eliminate high-interest debt. Credit card interest is like a financial anchor dragging you down. If you're carrying balances at 20% plus interest, you're burning money. Focus on paying these off aggressively, even if you can only tackle a little at a time. Start now. 3. Build an emergency fund. Aim for 3 to 6 months' worth of expenses in a liquid savings account. This isn't for investing. This is your buffer when something unexpected hits. Job loss, medical bills, car repairs. 4. Diversify your investments. If all your money is in the stock market, you're vulnerable. Look at other asset classes. Dividend-paying stocks for income. Precious metals like gold or silver as inflation hedges. Real estate, if it cash flows in your market, for long-term wealth building. Even short-term treasury bills can be safer options right now. 5. Increase your income if possible. Consider side gigs, freelancing, or using your skills in new ways. In times of downturn, income security is just as important as cutting spending. 6. Stay informed, but not paralyzed. Keep learning, but don't fall into analysis paralysis. Take small, deliberate steps. Economic turbulence creates winners and losers. The difference often comes down to preparation and mindset. Let's be honest, we can't control what the Fed does or how Wall Street reacts or whether inflation spikes again. But we can control our response. And if you're watching this video, chances are you're already a step ahead of most people because you're paying attention. Tough times reveal strong habits and smart strategy. Stay sharp, stay calm, and keep preparing. The truth is, most people can't do everything at once, and that's okay. But even starting with just 1 or 2 of the steps we've outlined today can put you miles ahead of the average person, especially those who are still swiping credit cards without a second thought. Household debt is now at an all-time high, and that alone should be a wake-up call. Your number 1 priority right now? Protect your capital. That means protecting it from both inflation and a potential market downturn. This is exactly why we've emphasized diversification and cash flow investments, not just chasing speculative growth. You want to own assets that can hold their value and actually pay you during uncertain times. The key takeaway here is simple. Be prepared. There are massive economic shifts heading our way, and they're coming faster than most people think. We had a lot more to cover in this video, but we're going to break that into a separate deep dive later this week. So make sure you're subscribed with notifications turned on because you won't want to miss what's coming next. If you found this information helpful, please share it with a friend who might need to hear it. And check out this video right here. It goes even deeper into the warning signs most people are still ignoring. Thanks for watching, and stay ready.